Hey guys, Tyler Jeffcoat, seller accountant. We're in this series called How to Appraise, How to Value My E-commerce or Amazon business. In the first video of the series, we really gave you a broad stroke. In fact, I was so excited I recorded that video at the house, wanted to come on in here to the studio to record this next one. And so we talked about what makes appraising this kind of asset, not just a business, because businesses are a lot more complex than, say, buying a car or valuing real estate. But within this gigantic ecosystem of businesses that you can buy, believe it or not, an Amazon business is a little bit simpler. They're more homogenous. More of the variables are measurable and comparable. There are comps that make it easier. And so now we're going to get into this video, which is we're going to talk about three things in this video: seller's discretionary earnings, SDE, you hear that term a lot. We're going to define Addbacks and how those relate to value. And then we're going to talk about multiples and how multiples impact the value of your business. You know, just warning, this is a little bit more technical in the sense that we're going to dive into a picture of a P&L. Hang in there with me. And if you end up having any questions, just shoot me a message. I'd love to try to answer them. Okay, so here's a simplified example of a profit and loss statement. You can see this seller over the course of 12 months. By the way, when you're valuing an e-commerce business, we're looking for seller's discretionary earnings or profit or owner benefit over the course of 12 months. It could just so happen to be a calendar year if you're going to market in January or February, but more likely you're going to use what's called trailing 12 months, the most recent 12 completed months when you go to value your business. So this particular seller did $1 million in sales over the last 12 months. They had some product COGS, some logistics fees, the Amazon commissions. And so their gross profit was $340,000. They had advertising in two different categories. They had their Amazon PPC or sponsored product ads. They had some other advertising dollars that they spent that were more directly related to to getting their customers to purchase the goods. And that resulted in a metric that you hear me talk about a lot on these videos: post-advertising gross profit. PAG does not show up on your P&L, but it's a great way to understand how effective your portfolio is at generating profit, because it takes gross profit and goes a little further down your P&L to capture your advertising expenses as well. You're going to have everything else that's your expenses related to the business that's called overhead, right? Salaries, rent, contractors, professional services like accounting, whatever, that kind of stuff. And then you're going to be left with an operating profit. So in this situation, you can see that the operating profit was $100,000 or 10%. But what we'd like to arrive at is seller's discretionary earnings, which means the market is going to allow us to what's called add back some of our expenses. So what I've done here is I've kind of exploded the overhead portion of this P&L, and the total overhead still $140,000. But now we can see the underlying expenses: rent, contractors, kind of an office software. This might be like a G Suite or Adobe or Microsoft Office. We have our e-commerce support tools, so say Seller Labs or Helium 10 or Sellex or one of those tools like that. Maybe an ERP like Skubana or Inventory Lab. And then maybe what I'm paying myself or my wife or my husband or whoever's helping me in the business. And so the investors are going to view these classes of overhead differently. Some of these overhead expenses are likely to continue to be expenses for the new owner and therefore are not add backs because they need to be deducted to arrive at your profit, right? In other words, a good example of this is probably e-commerce support tools. If I'm if I'm using, for instance, like an ERP inventory management system like Skubana, Skubana might be the core tool that I use to manage all of my POs and receiving and tracking of inventory throughout all of my sales channels. Well, guess what? There's a good chance that whoever buys your business is going to need to continue to use the tool in order to manage the inventory on an ongoing basis. And so you're probably not going to get to add back a lot of your e-commerce support tools unless there are clear redundancies in there. On the other side of it, if you're renting a particular warehouse or office space that isn't going to be reused by the future owner, you're almost always going to be able to add back rent. Owner salary is another category where if you're paying yourself, that's a very obvious add back to not punish your profitability. You're going to add that money back. But then there's a lot of them that are gray. For instance, some e-commerce support tools, the buyer may already have them, and they don't have to assume this expense from you. And the same thing with contractors, where, well, is this a contractor that's actually core to the business, where if she disappears, the business is really harmed? Or is this a VA that helps me manage my email, in which case it's clearly going to be an Addback if it's a VA, and if it's a core employee to the company, it's probably not going to be an Addback. And so here's the most important rule of thumb here. You win every Addback battle that you don't have to have. What I mean by that is, if I can just be lean and mean on my P&L, if I can just keep all of the unnecessary expenses off to the extent that I can, and then pick a couple of categories. Like, for instance, if I'm filing as an S corporation, I'm going to have to pay myself a salary at some point. That's fine, but make that really clear in your profit and loss statement, so that I limit the number of arguments that I have to have with my future investor on what is a valid add back and what isn't. And so let's talk about the mechanics of this. So I've got an operating profit. The investor is going to give me the opportunity to add back some expenses that will not carry forward to him or her. So let's say, for instance, rent is going to be an add back expense. Let's say that the Microsoft Office and kind of Google Suite and Adobe are add backs that they're going to let you get credit for. And then, of course, your owner's salary is an add back as well. And so what we've done is we've taken operating profit of $100,000. We've added back to that operating profit some expenses that are not going to be counted against us, and we arrive at an SDE, or seller's discretionary earnings, in this case of $185,000. That's SDE. SDE is basically, let's take your profit and loss statement. By the way, your P&L has to be stated on an accrual basis, meaning your cost of goods sold, if we kind of go up here a little bit, your cost and your sales need to be matched in the proper month, so that this gross profit number doesn't fluctuate every single month, that there's fairly steady margins. You're capturing expenses in the right month. But once you do that, you're going to arrive at your SDE by adding back some expenses that your investor is going to let you add back. Now let's take it a step further and talk about multiples. Now that we have our SDE, we've determined that $185,000 is the trailing 12-month SDE for this business. The market is going to assign a multiple to that SDE. So you're going to value it at 2x. That would be 2 times 185,000, 2.5 times, 3 times, 3.5, 4 times. We're seeing deals go north of 4x right now. And that's going to depend on a lot of more complicated factors. How dominant is your product? How much of a moat do you have? Do you have any IP? How complex is your supply chain? How solid is your supply chain? How great are your margins? How quickly are you growing? Right? How strategic are you in terms of being a piece of the portfolio of the buyer that's going to acquire you? All of these factors, how great are your systems and processes documented, or all of these things can add into increasing the multiple the market will pay for your business. And then, of course, if you have lower margins, or you're in a declining business, or you're, not on the first page of the organic results normally within Amazon or something like that, you may see that harm your multiple. And so that's the 3 things I want to talk about today, which are SDE. You can't get to SDE without understanding Addbacks. And then once you have your SDE, what we want to do is apply a multiple to it. And the market, beauty is in the eye of the beholder. So the market's going to give the multiple based on how strong our business is. And that will determine the kind of cash flow value of our business. Now, inventory also plays into this. And in our next video, we're going to really sink our teeth into how inventory impacts the value of your business. Take care until then.